and good morning. Welcome to the live series Straight Off the Bat. Join us on Thursdays as we speak to individuals across multiple industries who will help you understand financial literacy and education. If you're joining us from Facebook today, don't forget to like and follow our page to stay updated with content that will help you manage your money. I'm your host, Pauline Joseph. And as you know, we do this a lot and we try to share as much information as possible. But before we begin, I want to take a moment to acknowledge the recent devastating house fires in Los Angeles that have impacted so many families. And these strategies remind us of the importance of safeguarding our homes, not just physically, but also financially. That's why today's topic is so important, because we'll be discussing what you should know about mortgages in Trinidad and Tobago. We want to help you understand how to make smarter financial decisions when it comes to owning or refinancing your home. And today we're joined by Kieran Ramdeen. He is the manager of home financing at Scotiabank Trinidad Tobago Limited. He holds a master's in finance and has considerable banking experience. In 2016, he was the top sales officer in Trinidad and Tobago and the Eastern Caribbean region. So we want to welcome back Kieran. We just want to give you a heads up, guys. You've seen him before. He is in great demand by you. So welcome, Kieran. Welcome back.
Hi, good morning, Pauline. Good morning to all our viewers. Thank you very much for having me again.
Well, thanks for joining us. And the title will say, the top 3 things you need to know about mortgages. But guys, this is going to be 60 minutes of very important information that you will use and I will use, because I privately had a conversation with Kieran because I needed to have all this information just for me. So you and I are on the same page, and let's try and get as much information from him as possible. So let's talk about mortgage refinancing. What does that even mean? Because in our previous sessions, guys, if you missed that, not to worry, we'll try and put a link in the comment section so you can check that out. But what is mortgage refinancing?
All right. So, Pauline, so mortgage refinancing is basically taking additional funds or restructuring your mortgage. A lot of persons, you have a current mortgage, you want to get additional, so there may be additional equity available on that said property. So a lot of persons come to us to restructure that mortgage to get that additional equity. Some of the major reasons why persons will request a refinance of their mortgage is a few things, right? One is that probably, a financial situation has changed where income has reduced or something financially is happening where they probably want to extend the term for a lower monthly installment, again, to stay within their budget, to make sure that they're comfortable with the payments associated with the mortgage. Some persons want to refinance again to get the equity on their property. And I'll give you a quick example. A customer might have a mortgage for valued, the balance is 400,000, but the property value is 2 million. Based on our policy, we can do 90% of that property. So what that means is that we can do a mortgage and upstamp the mortgage back up to 1.8 million. That will allow them to now have $1.4 million in hand, in which they can utilize it for any personal need, such as purchasing another property, purchasing a piece of land, children's education, purchasing a vehicle, or a mix of financial needs that the customer may have at that point in time. A lot of persons take it for savings, investing for the future, right? So a lot of things pop up when we start to speak about refinancing. So we can now marry the both where, you have different financial needs, as well as we're looking at what is affordable for the customer at the end of the day. So we do factor in your income, your debt service ratio, etc., right? To be able to ascertain how much this customer could qualify for when it is that we're doing a refinance. But a number of different advantages in doing the refinance to get the additional funds available on your property, right? In which you can now make significant purchases.
Okay, well, thank you so much for that, Kieran. When it comes to this refinancing conversation, mortgage in general can be quite a heavy word for most people. So I want to figure out who should be considering refinancing, because I have friends who outright say, I'm not going to get a credit card because my mentality does not fit having a credit card and having that sort of debt. So when it comes to refinancing, who should be thinking about this type of step?
Right. So the refinancing will be primarily persons who have, and I'll kind of speak to equity takeouts as well, right? So anyone who has a property, whether it is mortgaged or not. So we'll have persons who have a property, they own a property, and they don't have any mortgage on it. They can take equity on that property again to do similarly to do the purchases and get that funds in hand. Persons who will look at the refinancing will be persons who already have that mortgage. So one, they may have a mortgage outside of Scotia, right? Or with Scotia, right? And they want to get that additional equity, right? You consult with one of our mortgage specialists. We will review your financial position based on the value and taking your entire financial position into consideration. Then we'll be able to better advise you in terms of how much you qualify for, etc., and what are the next steps to be able to get the equity or restructure the mortgage accordingly.
Okay, thank you so much for that. So when it comes to refinancing, because the word in itself, I mean, it sounds technical, but the idea is you're going to take something out of, in terms of cash value from an asset that you have. Is that fair to say?
Yes, correct. So that's exactly what it is. So utilizing your real estates, right? The bank holds the property as security, right? Until you're able to now settle that facility. So once your mortgage is settled, then we can now release the property back to you unless you want to now refinance again, right? So that's something that a lot of persons look at, and I want to share some of the advantages of doing the refinance because that's important to note, right? A lot of persons come to us and they significantly indebted, right? May have multiple facilities and they may encounter a little challenge in terms of being able to pay the facilities on a monthly basis. Again, financial commitments, things change, salaries for some reason decreased, whatever it is. We're here to see how best we can support, right? So what we look at now is refinancing, now trying to get this customer to get a smaller monthly installment. So we will have customers, and again, sharing this example, we may have a customer who is paying $9,000 per month because they have a mortgage paying 5,000, they have a credit card, probably 1,000 being allocated for that, and they have two loans at $1,500 each, $9,000 a month, but their income, they can't afford it due to financial constraints. So what we can now look at is utilizing the equity on the property, whereby we can now pay off these other debts and have one monthly installment. The benefits to the customer is that your cash flow is now enhanced considerably, right? You have a lot more in hand, right? That residual income on a monthly basis in which you can now live comfortably, right? What you will want to take into consideration though is that when it is that we refinance the mortgage, it most likely will be for a longer term, right? But at a lower rate. So you want to take that into consideration. We do have different options in which you could pay off the facility faster, but the key here, a lot of persons benefit from is having that smaller monthly commitment, right? However, so again, I advise customers, the benefit of taking a facility for a longer term is that you're committed to a smaller monthly installment, but we do have the option to make lump sum payments to the facility because persons may think, okay, I'm going to refinance. This is my mortgage is going to extend my term by another 10 years. But now we have to look at holistically your full financial position at this time. And could I afford to pay all these debts or should I refinance my facility so it's more manageable, right? But still me having the option to make lump sum payments to the facility to still pay it back off within a reasonable time. So that those are some of the considerations persons will have to make when it is that they're looking at refinancing.
Thanks for that, Kieran. And also thanks to Anita Singh, who's joining us from Facebook. And she's watching from Central. As for the West folks, that's Beyond the Lighthouse. And we are so grateful that you're joining us today. Okay, so when it comes to this conversation around refinancing, we have to talk about common mistakes, right? Because not all of us have someone to have this discussion and to actually sit down and explain these things, because learning takes time and it'll take a few more attempts at watching these videos to really understand what Kieran is saying. I'm not just talking about you guys, I'm also talking about myself. So let's give us, like, 2 or 3 common mistakes that people should avoid when refinancing a mortgage.
Right. So again, you want to make sure that, I will say, you want to make sure you have a purpose. There's a need to do the refinance first of all, right? Again, you want to refinance for a purpose, right? Whether it is the education, purchasing another asset, etc. You want to have that purpose, because you don't want to just refinance. Whilst it is good to refinance, get some funds in hand and invest the funds, whether it is for retirement savings, etc. What we want to look at is, one, having a purpose for those funds, and again, ensuring when you refinance, you take into consideration a lot of factors. Your age at retirement, if it is that you expect any change in your financial position, you want to take those things into consideration, because obviously that is going to impact your ability to repay the facility. Remember, this is a mortgage, so we're holding our assets. We're holding, most of the times, your primary residence, right? So we want to make sure that you're able to pay the facility. So you don't want to take too much, and that's why, in our previous session we spoke about your debt service ratio, for the bank to ensure, to give some level of comfort that this person can still pay the facility, while still covering their regular monthly commitments, right? So ensuring that you have a purpose, right, and ensuring that you understand, you have a good gauge of your financial position, taking into consideration, if I do a 20-year term, I'm retiring in 10 years, then how does that work for me? My income is going to reduce significantly. What plans do I have in place to make sure that I'm able to continue paying this facility? Or am I going to make lump sum payments on the mortgage to be able to pay off within my retirement age? Right? So those are the things that I will say persons need to consider when refinancing and taking facilities in general.
Okay, so for those out there, guys, listen to this. That means don't refinance for your costume. I'm just saying it. I'll be the one to say it, okay? You don't need to say it, Kieran. I will be the devil's advocate.
Sure,
Would you
sure.
agree with that? Would you agree with that financial advice?
Yes, again, you want to you want to put yourself in a better financial position. You want to make sure it makes sense refinancing, right? And again, utilize it for purposes that it will benefit you, benefit your family, right? Because again, we're here to give that support, and again, that's why we have the session for proper financial advice.
You heard it here first, guys. You heard it here first. Okay, so we have some questions in the comments, and I want to get to one of them before we go on the break. And an answer wants to know from Facebook: after how many years on a mortgage can it be refinanced be done?
Right. So you will have, right after, basically you can wait probably about a 6 month period, but it depends, right? So, for example, you may purchase a property, and this is where the term will be dependent on. If it is, I purchase a property today, and I'm purchasing for $1 million, and I inject 10%, where I borrowed 900,000, then at this point in time, there isn't really any equity available for us to refinance and give you any additional on that property. But another example is, if it is, I purchased for $2 million, but the property is valued 2.5, then there's equity of 500,000 available, right, on that property. So if it is, I purchased today, I can come back next month, next 2 months, next year, and say, okay, I want to take advantage of the equity available on the property. So it all depends on how much equity you have available, because if you recently purchased and the balance is at 90% or 80%, right? The possibility exists, whilst you may be able to refinance, you may be limited in terms of how much equity you can really get on this property. Yeah, so you now have to look at the current balance as well as the market value of the property to then determine how much equity do I have available that I can leverage on.
Okay, so we're going to go on a break, but before we do that, we want to just shout out to Wendell on Facebook. We're going to get to your question, which has to do with what is Scotia line in terms of sort of refinance or equity in a form. Okay, in a form. I will reread that and hopefully we will get that clear. But Wendell, just, if you want to expand on that as well. And also, I need to reiterate, Kieran here can only speak on Scotiabank because that's where he works. So we'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from YouTube, don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we're discussing what you should know about mortgages in Trinidad and Tobago. More specifically, we're looking at, some of the things that we should be thinking about before buying a home in Trinidad and Tobago. So we want to welcome back Kieran. He is joining us from Scotiabank today, and he has a wealth of experience that we all we're trying to figure it out, man. We're really trying to figure it out. So we're going to squeeze out as much information as possible. But before the break, we mentioned that we're going to answer Wendell's question. He's joining us from Facebook, and the question has to do with, is the Scotia line a mortgage refinance tool? Okay. Is that, yeah.
So good question, Wendell. Thanks for that. So a Scotia line is a revolving credit facility that Scotiabank offered, right? It is not a facility that we have currently available to customers. Persons who benefited from the Scotia line previously, they will still have it until it's closed, right? Just to give a little insight of how the Scotia line worked, right, is a revolving facility similar to a credit card, but this facility was more geared towards getting cash from the facility, right, where you were able to withdraw physical cash, right? You had a card as well. There were two types of Scotia lines. You had a card for it, one of the types, right? But it is really a revolving facility whereby you can have access funds based on the available balance, that is, right? It was a hybrid between a Scotia loan and a credit card, but currently it's no longer available. To your question, Scotia line, no, right? Because that's a revolving facility. So a mortgage refinance will be utilizing real estate, where we utilize a property, whether it's land only or house and land, right? And we utilize that property as security to advance funds to customers.
Okay, so I have some questions, but it's not as important as the questions in the comment section because they're coming in hard and fast. So we're going to try to answer as many as possible. So we have a question coming from Tariq. I'm hoping that I'm pronouncing your name correctly, Tariq Ali. Is it a wise idea to take the equity from your property and make other mutual funds investments with Scotiabank?
Yes, so Tariq, definitely. Again, earlier in the conversation, I spoke about different purposes persons will normally reach out to us for to get equity on their mortgage or their property. And definitely, we've seen a lot of persons take the equity to now invest, um, utilizing different instruments, whether it is our Scotia mutual funds, investing it in a term deposit. We have our Scotia insurance partners, a number of different investment opportunities that Scotia presents, right? Whereby persons leverage on the equity to now invest. Again, you may have a young child, you're planning for their university expenses, you want to safeguard and ensure that you have the funds readily available. So persons will leverage on the equity. Persons say, here's what, I'm going to retire in the next 15, 20 years. I want to be able to have cash available. God forbid something is to happen for medical situations, for my family. Let me take the equity now while I could qualify and set it aside, invest it in, again, the different instruments, the investment instruments that Scotiabank has to offer, right? So we've seen that popping up quite a bit. It's very frequent. So definitely something that we can do and assist you with.
Okay. So we're going to continue with, hello? Oh, there we go. We had a little delay there. All right. So thanks for that question again. We're going to head over back to LinkedIn, and we have another question from Sonjil Labarid Agad. Why would one tap into the equity for savings when the internet interest rates are lower than current mortgage rates? It's very technical. We have such smart people on this live stream, and I think Kieran is the only person that will be able to answer that question. So you want to tap in on that?
So again, having a purpose, that's critical, right? We have instruments that can potentially give you significant returns, right? Again, it's all what you invested in, right? Some persons, again, may say, okay, real estate might give me the best returns. Some persons may say, here's what, let me safeguard the funds that I have available, right? Set it aside and invest it in the different instruments. So it all depends on what you invested in and what is the aim at the end of the day. Some persons may invest it for the short term, say, okay, I have a need, but is probably in the next 5 years, I might need to get the funds, right? But again, you now have to look at the financial position to then determine, okay, next 5 years, can I qualify, right? What is my plan? So as an individual now trying to ascertain, okay, should I take the equity or not? You have to take things into consideration. The purpose is critical again, right? And what you invested in is obviously you will want to do some digging, do some research, and understand what will give you the best return on your investment. Yes, Scotia has quite a number of instruments available, right? We have really good returns on our mutual funds, Scotia Insurance. So again, that's an option available, right? With respect to the difference between the rate on the mortgage and the rate on the investment, again, that's consideration you will have to now look at and see if it makes sense for you. Because again, not everyone will be able to get the equity at a later age. Not everyone will be able to qualify. So some persons say, here's what, let me take it early o'clock rather than wait till I'm closer to retirement where my financial position may change and then I'm unable to now leverage on the equity available. Yeah.
Thank you so much for that question coming from LinkedIn, Sonjil. I have some questions about mortgage insurance, but we're going to have to get that at a later date because I really want to get to these questions that are coming in. Samantha, I'm going to come to your question just now because I feel the same way about this question. But before we do, we want to ask the one from Candice. She's on Facebook. How many times can a refinance take place?
Right. So Candace, really good question. The max we can look at is 3 times, right? We don't really see persons taking refinances that much, like more than 3 times, right? We really see probably once or twice tops. And let me just share again, there's pros and cons to everything, right? And obviously, you want to be able to make the best financial decision. So you want to look at, okay, The benefits to you refinancing your facility is that you're now able to, one, either, as I said before, more manageable installments, able to enhance your cash flow, you're able to consolidate your debts or get additional funds to meet an immediate need, a need that you may have, purchase another asset, etc. The flip side to it is persons need to take into consideration, when I refinance my mortgage, what does that mean? And you want to look at the mortgage and how it works, right? With a mortgage, it's based on simple interest, principal by rate by time over 100. So we're going back to school there. So basically, what that means is with the mortgage, when you make a payment on your facility, the payment is split. It's split between principal and it's split between interest, right? To give you your total monthly payment. What you need to take into consideration is that when it is that you make that payment, because of how the mortgage is set up, right? A lot more goes to the interest upfront. So what that means is that typically in your first 10 years or so, a lot more goes to interest. And then the principal balance is where, you will see at the later part of the mortgage, the balance is significantly reduced. So what that means is that if it is that I took a mortgage 10 years ago and I'm now looking at refinancing, I now have to look at how much my principal balance actually went down by, because I would have paid a significant amount of interest in the first 10 years. So that's definitely something that you will want to consider. What I advise customers to do, which we have available at Scotiabank, is that if it is that you have a mortgage that you have for some time, then you want to weigh the options. We actually can do a second mortgage on the same property. What that will mean is that you wouldn't be starting over the initial mortgage. So you'll have two separate mortgages. We're holding the same property, right, as security, but you have two separate installments. Again, pros and cons. You now have to look at this, right? And I've given examples for persons to better understand um, and my rationale here, right? If it is I took that mortgage, I took 900,000 10 years ago, my installment is say $4,500 currently, or I'm paying 4,500 since inception of that mortgage, right? And my balance now is 500,000. If it is, so I'm showing you the two options here. If it is that I refinance the mortgage and I go back up to the 900,000 and I take the same term, and providing that the rate is the same, etc., I might be paying 4,500. If it is that I take the second mortgage, then be mindful, you're paying 4,500 currently and the balance is 500,000. If I take a second mortgage, that will mean that I'm doing a second mortgage for 400,000. The installment might be $2,000. So you now have a mortgage paying 4,500 and you have one paying 2,000. So 6,500 opposed to 4,500 initially. Again, persons will now need to look at their financial position, because at the end of the day, what you want to take into consideration is, could I afford this 6,500 or do I need to refinance it to make my financial position comfortable, whereby I can only pay 4,500? But now if you refinance, then you know, starting over that mortgage, all the interest that you would have paid over the last 10 years, you're now going to start back that wheel again. So you want to take that into consideration. So persons now have to weigh the options. Do I pay the higher installments, which will mean I don't start over that process and start overpaying interest on that 500,000? Or do I really need to refinance and have one installment back at 4,500, but then again starting over the wheel? So something to consider when it is that you're refinancing.
Thank you so much for that, Kieran. And if you may need to replay that, because that's information that we will need to look at a few more times, not to worry, this live, once it's ended, will be available for replay across social media. So Samantha has a great question from Facebook, and it's a question that I know Kieran has the answer to, because I literally picked up the phone and called him and asked him this question. So he knows, I know he knows the answer to this, but we will answer that question right after the break. We'll be right back. and welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from LinkedIn, don't forget to smash that follow button so you can continue seeing content that will help you manage your money. Today, we're discussing what you should know about mortgages in Trinidad and Tobago. We were initially thinking about maybe doing, three main topics, but you guys are the director of this live show, so whatever you say goes. So we're going to welcome back Kieran. He's the manager of home financing at Scotiabank Trinidad Tobago Limited. And just before the break, we covered a wealth of knowledge that I'm sure you're going to want to watch on the replay. All the links are in the comment section. So we're going to head back over to Facebook, and Samantha wants to know, not a refinance question, but as a Trinidad national living and working abroad, is it possible or how easy is it to get a mortgage for a rental property in Trinidad?
All right, nice. So, very nice question. So, firstly, we will want to take those applications and discussions case by case. I will give you some general information, but definitely I will recommend that you reach out to us so we can have a further one-on-one discussion to understand better what the expectations are and next steps. But we do have financing options for non-residents and persons who are citizens but work abroad, right? So the option is available. Terms and conditions will differ though. So that's why we will definitely need to have a one-on-one discussion to discuss further, right? So it is available. We at Scotia, we can do up to 3 properties. We can do your primary residence, we can do a secondary or vacation home, and we can do financing for a rental property as well, right? Again, it will depend on when we're speaking about rental property. Is it that we're looking at one house, we're looking at apartments, and then when we speak about the individual units, how many units you're looking at, right? Under our residential policy, we can do up to 4 units for persons who are not first-time homeowners. If you are a first-time homeowner, we can look at the option of doing 3 units. So 1 building, 3 units, or 4 units, right? So it is possible. There's options available, but again, that's where we will have to have that one-on-one discussion to discuss further. Yeah.
Okay, thanks again to Samantha for that question. And Jarell Alexander on Facebook, we answered your question. Speaking of reaching out, just give us a holler on our sign up page and we will connect the dots with you. So thanks for letting us know. So we're going to head back to Facebook, and Laureen wants to know, can you please elaborate on penalty fees involved in wanting to pay off a mortgage facility early before its end of term?
Nice. So on the mortgages, we do have a penalty interest that is applicable, right? The standard policy is 6 months penalty interest. Something to take into consideration though, again, if it is that I take a 30-year mortgage and the intention is to pay it off after say 12 years, what you want to take into consideration is that I'm going to save on 18 years interest, right? So whilst there's a penalty noted, which is 6 months penalty interest, you are going to save a considerable amount in the long run because of all these years of interest that you basically didn't pay, right? So standard, yes, we do have a penalty for early settlement of your mortgage, and it is 6 months penalty interest.
All right, so we're going to switch the conversation a bit because, the comment section dominated our conversation for quite some time. So we're going to shift over to what is a mortgage insurance. We have this conversation around home ownership, and we're thinking, okay, I just have to save money towards the house, but there's so many other different fees attached to it. So let's start really bare minimum. What is mortgage insurance?
Right. So we actually have there are two things you need to take into consideration when we speak about insurance. So there's 2 sets of insurance that is normally required, right? Well, one that is mandatory with Scotiabank and one that is optional but highly recommended. So I will speak about the property insurance first of all. So as I mentioned before, we will be holding this property as collateral, as security to now advance funds to the customer. What that basically means is that we need to ensure that both yourself and the bank is safeguarded in the event of a fire or a natural disaster. So once it is that we are advancing funds to you, on the date of doing that advance, we will want to ensure that you have adequate insurance coverage in place, again, in the event of a fire or natural disaster. And it's also assigned to Scotiabank because we will have a mortgage. We'll be have a first mortgage and a first demand on the property. So in the event, for example, there's a fire and the insurance needs to pay out on a claim, the insurance will normally write the check directly to Scotiabank so we can ensure that our security is the funds are utilized to bring the security back into average or better condition to make sure whatever damages that took place that we able to ensure that it's back into a good condition to safeguard our assets, right? As well as for you to ensure that you're not paying a debt. God forbid there's a fire, you don't have insurance, you're paying a debt and you don't have that asset, right? So we want to make sure that's mandatory. The second insurance that I mentioned is life and or critical illness insurance, right? So life insurance, I wouldn't speak too much on it, right? Because that's a whole insurance topic. But life insurance is basically, God forbid, you pass away, no one in the family will have the burden in terms of paying off that debt, right? So whilst it's not mandatory with Scotiabank, it's highly recommended because again, example, you have a family, you are the probably sole breadwinner, or your income is significantly higher than your significant other. What that basically means is that if it is, God forbid, you are to pass away, your family will have the burden in terms of paying off that facility, especially if it's your primary residence. You now have to take into consideration, okay, I pass away, my children, this is the house that they're living in, what is going to happen to them. So it's highly recommended that, persons take out life insurance, right, to safeguard their family, right? There's also critical illness coverage, right? God forbid they suffer critical illness. Again, no one in the family will have the burden in terms of paying it off their life, but now you have to take into consideration, will they have the income that they have currently? Will they be able to work? Will they now be able to probably work but not do the strenuous work that they could have done before, which brought in more income, right? So definitely the persons will want to take that into consideration, right? When it is that they are thinking about taking on a debt such as a mortgage or any other facility, because you want to make sure and safeguard yourself, safeguard your family and your assets.
Okay, valuable information. And in the same realm of insurance, is there like a specific percentage or a general idea that someone should expect when it comes to paying mortgage insurance in Trinidad and Tobago?
Right. So the first part was the property insurance. So it is all dependent on the type of property and what is recommended by the quantity surveyors and the professionals who already should be giving the recommended coverage. But the valuators will or can usually give a recommended coverage. So it will be dependent on what that coverage is, right? Recommended by those professionals. Um, Typically, I will say insurance coverage for $1 million, you're probably looking, again, based on the different insurance companies, etc., the rates will vary, but you're probably looking at around 3,500 to 4,000 per year, right? When it is that you're looking at the life and or critical illness, there's a number of different factors, right? And one of the major factors will be your age, right? And your current medical condition. So those are some of the things that I will recommend persons start to look at, right? If it is that you have a budget in mind, I'm looking next 2 years, I'm looking at buying a property for 1.5 million. Then from all now, you should start to look at what will be my insurance coverage. Do I need life? Do I need life and critical? So you will have a budget in which you can work with. Yeah.
Okay. So when it comes to, and I don't know if this is a technical question, but when it comes to the percentage off of what is owed, if like, let's say you're halfway through your mortgage and you are looking at your insurance, does the cost of your insurance reduce because you have paid off a majority of your loan? How does that work?
No, so it's actually based on the recommended amount. So it's not tied to the balance of the loan in any way, right? Because again, we want to make sure that the marketability of the property is in good condition, right? God forbid a fire is to occur, right? If it is that it your property is damaged, probably upstairs, or half of the property is damaged, then if it's not fixed, right, or it cannot be fixed based on the coverage amount, then basically the property, the overall value of the property could depreciate significantly, right? So definitely we will want to ensure that the full recommended amount is covered, because we don't want to under-insure the property. And guidelines can be provided from the insurance providers, because I know they rely heavily on the valuation to guide them in terms of how much coverage is required for that said property.
Okay, getting really technical here, but I think we have a general understanding of what to expect. For those who are asking for Kieran's contact information, just sign up, go to the link where you sign up for the batch rate of the live show. And once we get your information, we will forward it to him. I'm not saying that he will be the one directly to reach out to you, but I think someone within the organization will. So the conversation on insurance in general, because it feels like it's something that it's a lot of, thinking about your mortality, right? Because when people think about insurance, they're like, oh my gosh, I don't want to talk about death. And shout out to Tarek on LinkedIn, because he was like, give me a shout out for all your insurance needs. And I think it's an important conversation to have. And why is it important to think about this idea of, because you mentioned this earlier as well, you don't want to leave the responsibility of a mortgage, God forbid, knock on wood, something happens to you. But why is it important to think about things like that? Because we do have a culture where we don't want to necessarily talk about death. We've had on this said show, Shit of the Bat, we've had folks within the legal space talk about how people don't want to have the power of attorney conversation or the will conversation. But in the context of this and mortgages, why is it important for us to think about the afterlife, if you may, when it comes to purchasing a property?
Well, definitely, you touched on some key points there. And the first thing first is you want to get insurance as early as possible, because again, age is a significant part. And again, I don't want to touch too much on the insurance part, but age is critical. It really dictates your premiums, right? And again, you want to be able to be comfortable when it is that you take on a debt, that you do not leave that behind. God forbid something is to happen, right? Again, especially with a mortgage, you have your family living there, you have your children, you want to take them into consideration. You have to take them into consideration, right? And understand that if my income isn't able to afford because of a critical illness, or I'm no longer here to be able to assist with payment of this facility, what is going to happen to them, right? Because obviously, we hold the property as security. If the property cannot, or the mortgage is not being paid, then the bank has all rights to do the needful, right? I mean, it sounds harsh, but that's a reality. We have to take this into consideration, that the bank holds this property as security, right? we definitely empathize. Scotia has really done an excellent job in terms of working with customers, looking at different ways to refinance and tying it back in again. We probably have husband and wife making the higher income. God forbid, she's no longer in the picture. She's unable to make the payments. Could the husband now take up the burden in terms of paying that debt? So we can look at the option of again refinancing that mortgage, extending the term. Again, that person will say, "Oh gosh, I'm extending in this term. Obviously, I'm going to pay more interest, but it's in the best interest of my family because whilst I'm extending the term, I'm now getting a more manageable installment that I'm comfortable with." Right. So again, those are the some of the considerations that persons will have to make those hard decisions on.
Thank you. And I really like that example of the woman making more money.
I was wondering which one to put first, but as a let me say the woman making more money. Yes, yes.
I appreciate that. All right. So we're gonna go on a break, but when we come back, I mean, this question is actually something I saw online because, guys, I can see what you search for in Trinidad, and I saw the search term. I'll reverse mortgage pop up as one of the top terms when people are searching for mortgages in Trinidad and Tobago. So I don't know if that means refinance. I don't know if it's the same thing, but we're gonna ask Kieran the hard questions right after the break. We'll be right back. And welcome back to Straight Off the Bat, a show that helps you understand financial literacy and education. Thank you so much for joining us today. And if you're doing so from Facebook, don't forget to subscribe to our page to continue seeing content that will help you manage your money. Today, we're discussing what you should know about mortgages in Trinidad and Tobago. And initially, we were looking at the top 3 things you should know about buying a home in Trinidad and Tobago. But as your comment sections have shown, you were the director of this show. So wherever you wanted to go, that's where we're going. So we're going to bring back in Kieran. He has joined us from Scotiabank, and he is the manager of home financing at Scotiabank Trinidad and Tobago. So I know we do have a few more questions, but before we get to that, I just wanted to find out, what is reverse mortgage? Because that's something the folks are searching for online in Trinidad and Tobago.
So I'll try to answer that to the best of my ability. So I did some research on that actually some time ago. I believe, based on my research, it is the same as a refinance. I guess it's just a different term they use primarily in the US, right? But based on my research and findings, it is similar to a refinance in Trinidad, what we will call typically a refinance in Trinidad.
All right. Well, thank you for clarifying. And so if you guys out there typing reverse mortgage, just, backspace and put refinance instead. All right. So we're going to head back towards the comment section. And Kellyanne from Facebook wants to know, can you do renovations to a property during the mortgage term? Great question, Kellyanne.
All right. So yes, you can, but there are limitations, right? So in our agreement, when it is that we sign up our mortgage, we will indicate to our customers that in the event that you are doing any structural changes, and structural changes meaning increasing the footprint or the size of the house or the property, you will need to notify us, one, as well as before you do so, you will need to get the necessary approvals from the relevant authorities, being town and country and regional corporation, right? If it is that you are looking at what you need, what work requires the relevant approvals, I know town and country, they do have information on their website in which you can look at and see what requires the necessary approval. And I'll just share quickly with you. The footprint of a building means that, okay, if it's currently 2,000 square feet and you're doing an extension either going upstairs, which will change the living area or living space, or you're extending the building to now 2,300 square feet, then for that additional square footage, you will need to get the relevant approval, right? That being said, we will want to make sure that you have the approvals, because we don't want a situation where, for you as well as the bank, you do not have the approvals and then you're being stopped, right, while undergoing construction, right, to say that, hey, you do not have the necessary approvals, you need to now break down the whatever it is there, right? So it's important that we get the relevant approvals, and the bank is aware, the bank is advised that you were interested in doing the necessary work.
Wow. So it's definitely a lot of research that has to go in before committing to this, because it's not just I want to do renovations on my property. It's I need to make sure all the right players in place, because you don't want to start something and then you're not allowed to. So maybe
Yes.
that's something we can look at for future live shows, having Town and Country
Yep.
on our live session. So
Just,
that's
just,
great to
to
know, guys.
just to add as well, I just want to give an example. So for example, if you stay within the 2,000 square feet, right, and you're doing internal changes, and again, I don't want to speak too much on the town and country aspect, but based on my knowledge and understanding, is that if it is that you are doing internal changes, such as you're breaking down a wall to probably extend internally, right, extend or change up how the structure is, where you have you're changing probably two rooms into one, where you're doing an opening or you're breaking an internal wall, right? That's something based on town and country guidelines that may not require approval, but definitely you'll want to seek guidance just to make sure that you're within you're within their policy, that you do not need the necessary approval for. Yeah.
All right. Thank you so much for that. We're going to switch the conversation over to assets. Is it possible to use a mortgage as a tool to invest in real estate?
Yes, but that being said, you'll need to be so is one of those two, right? Is either you own the property already, whereby we can take the equity on the property to now invest and purchase another asset, or in general, you're now looking at purchasing that property, in which that becomes your asset, right? So there's two options: taking the equity on an existing property, whether it's a refinance, so refinancing to get the equity, or if it is that you have a property that doesn't have a mortgage, you can look at the option of taking the equity to now invest in terms of purchasing another property.
All right. And this question, it's really, when you come to the first time investors, what should we know about securing a mortgage for investment properties? What is what the first, maybe two things we should know?
Okay, so you want to ensure that you understand what you're looking at purchasing, right? Obviously, so this is utilizing a current property to now purchase an investment property you're referring to, just to clarify.
Say that again.
So we're utilizing an existing property that the customer owns to now purchase another property.
No, like if you're doing it for investment purposes,
Right.
an asset. So you have a property that you're looking to secure for investment.
Okay, so under our residential policy, under retail, right, as I mentioned before, we can do for first-time homeowners up to 3 units, in which you could you live in one, and you can look at renting out the other two, right? And it's not commercial rental, but for rental for personal use, right? So, for families, right? If it is that you are not a first-time homeowner, we can do up to 4, where you reside in one unit and the other 3 can be rented. Again, it is something that we can afford on our residential side, right? Where you can benefit from the residential rates, terms and conditions, right? Depending on what exactly, again, so they're speaking general here, depending on what exactly you're looking at. Then if it's more than the 4 units, or depending on the how the building is structured, etc., we may need to refer you to our business banking department. So again, those are some of the things that when we have that one-on-one discussion, we'll be able to dig deeper and better understand the nature of the request.
Okay. So speaking about mortgage rates, and this will be our last question as we close off. What are mortgage rates? Like what exactly is this? And this is also going back to what I mentioned earlier, where I checked on Google and I realized a lot of folks are searching for mortgage rates across Trinidad and Tobago. So what are they and why should we know what they are?
All right. So the rate is basically the cost involved in taking on this debt, right? Obviously, the bank will want to ensure that they're able to make a profit margin on whatever facility that we are advancing. The intention here when we do a mortgage is that the bank can benefit from the interest on the property, on the mortgage. The advantage to the customer is that they're able to secure debt, that if it is that they do not take the mortgage, could they really afford or save up that funds to be able to acquire that asset, right? So it is an instrument that we're able to now meet the customers halfway, where at the end of the term, they're able to settle the mortgage. They have the asset as, yeah, they have the asset for future generations. The bank benefits from the interest that was gained throughout the payment of this facility. So when we speak about interest, we want to look at interest on your facility. Again, as I mentioned, when it is that you make your payments, the payments are split between principal and interest. We have full disclosure in terms of the total interest cost a facility, how much it will cost you to undertake a facility, right, with Scotiabank. Just for you to ensure that you understand, okay, how the facility works, right? It's important that persons understand that obviously the bank will want to ensure that they have interest being gained on the mortgage, and again, you will benefit from the asset at the end of the day, right? Interest will be applied throughout the term of the mortgage. So over the 20 years, 30-year period, you will be paying both principal and interest on your mortgage, right? Something to note, in markets, 99% or 99.9% of persons is a variable rate mortgage that we look at, right? So it will have fluctuation. It will be, the interest rate is normally reviewed on the anniversary of your mortgage. So on an annual basis, it will be reviewed, right? Persons need to take into consideration two things that will drive, that you are in control of, that could possibly drive the interest rate. And the two things will be, one, your repayment history. Risk is in line with return. So obviously, if it is that you're not paying your facility or not paying it timely, then obviously there's a risk, right? That mortgage is now at more risk than another. So potentially the rate can go up. The second thing that you are in control of is if it is that you take the facility for a specific purpose, and then the property is renovated or changed into a commercial property, then that is something that could potentially impact your rate, because the rate on a residential facility and the rate on a commercial facility, it's two different rates. So that's something definitely you will want to take into consideration.
All right. I think that is a fantastic place for us to end this discussion. Thank you so much, Kieran, for joining us today and sharing insight into what you should know about mortgages in Trinidad and Tobago, because we went beyond the top 3 things you should know before buying a home in Trinidad and Tobago. And thanks again for everybody in the comments for contributing to this live discussion. If for whatever reason we didn't get to answer your question, don't forget to sign up to our live shows, and from there we can connect and answer, because there are some follow-ups we need to do after this live show. So don't forget again to head over to the links in the comments across social media to sign up for future live shows. As always, be sure to like and follow our pages across social media so you don't miss a single live show, because this content is so important for all of us. So thanks again for joining us, and I'll see you soon. Bye.
Bye.